Target date funds, simple and often an encouraged investment for your 401k. Guys, they can be dangerous, especially during certain market environments. 2022 is one of them. I'll explain that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. One of the easy, kind of the simple button, if you're familiar with that commercial way back when, from Staples, I believe, investment approaches, is to just pick a prefabricated mutual fund called a target date. Now, I say prefabricated because you just buy one investment, one mutual fund, all your money's in that, and within it, under the hood, you've got your large cap stocks, you've got your mid cap, you've got your small cap, you've got your international, you've got your emerging markets, you've got your real estate. You're fully diversified. And then what's even better still, or at least the claim is, you can just hold this one, and as you get older, closer to retirement, they will automatically reduce risk for you, and it's just a glide path. You don't need to do anything. Pretty great. I mean, that would be wonderful if that worked and was a great idea. Here's the problem. There's some significant flaws with target date funds. Oftentimes, they don't have all ingredients of a fully diversified portfolio. Oftentimes, they don't hold emerging markets or real estate. They can be expensive, having layering expenses. You can't see what's underneath. And so typically, if you're investing in one company's target date fund, well, you're using that same company's strategy for large cap, small cap, and mid cap, and that same company's likely not great at all of those things. So you likely have some mediocre investments. And likely that risk adjustment that they're going to be making might not line up exactly with what's appropriate for you for your financial plan. It's out of your control. You can't even really see it. So lots of dangers. While it's simple, and it might be a way, if you're just starting saving, your 19-year-old's got their first job and they're saving in their simple IRA and they want to start with that, that's fine. But to me, once you get over $5,000, maybe 20 grand, something like that, the target date fund, I struggle with it being appropriate. Work with your CFP. If you don't have a CFP, maybe that's the default option, but it's not. It has some drawbacks. Okay, specifically in 2022, some of those drawbacks are amplified. Now, just so that we have a true kind of subject for this, I just randomly picked Vanguard's 2020 target date fund. So this is one that if you were planning to retire in 2020, thereabouts, they go in 5-year increments. So if you were planning to retire last year or this year, you're probably using, and you wanted to use a target date fund and you were with Vanguard, you're probably using this one, okay? Take a look at the allocation. 44% in stocks, 44% in stocks, about 1% in cash, 55% approximately in bonds, okay? So that's your makeup. That's what's underneath the hood, just barely, okay? If you go, you can go even further to see exactly what the holdings are. Various Vanguard funds. Again, is Vanguard great in every area? They're not. And so anyway, but if you're retiring, so let's say you're 62, 63, 64, 65, in that range, and you were just investing in target date fund, this would be your allocation if you're using Fidelity, Vanguard, something like that, for a target date fund. So here's problem number one. You're holding this fund, but you're in retirement. Again, this is the 2020 fund. So you're in retirement, and so to supplement your Social Security, you're drawing, let's say $1,000, let's say $2,000 out of this fund every single month. And what does that mean? You're selling this fund. Okay, great. Well, that's easy. I'm selling $2,000 of this fund every single month. But here's the thing. This fund owns 44% in stocks. Therefore, you're selling stocks every single month to get the income that you need. And when values are down like they are right now, you need to sell more shares in order to get the $2,000 that you need. Bonds are having their worst year on record. You're having to sell more bond shares at lower prices to get your $2,000, okay? So this is called reverse dollar cost averaging. It's the exact opposite of what you want to do. When you're working and investing and saving up and you're investing $2,000 a month, when stock prices are down, that $2,000, the shares are cheaper, you can buy more shares at lower prices. Therefore, that works to your advantage. On average, your average purchase price per share is a little bit cheaper because you can buy more when prices are low. The exact opposite happens when you're withdrawing. And one of the dangers with target date funds is people just say, well, this is my mix for retirement. It's going to work. I need to sell $2,000 a month in order to live. And every single month, you're having to sell more shares of the investment of stocks, or even in this case, bonds, which it's an anomaly, but let's focus more on the stocks. You're having to sell more shares because those shares are worth less, not worthless, they're worth less. And therefore, when things do rebound, you have fewer shares to capture that rebound. This is a unique risk and drawback to target date funds or other balanced funds if that's your approach in retirement. The other big danger, I already mentioned it when I was talking about the risks with target date funds, is if you're 62, 63, 64, 65, something like that, because you said, I'm going to retire around 2020 or 2021, 2022, so you've picked this fund, your retirement's going to last 20 to 25 years, and you only have 44% in stocks. Guys, to me, that seems a little low. Now, I'm not suggesting you should have, 80%, but 50, 55%, some of these dollars you need to grow for the next 20 to 25 years, and to only have 44% in stocks, and worse yet, as you're selling those investments to supplement your Social Security, selling more shares of those at lower prices, it's going to be very difficult for these dollars to last as long as you need them to. So this points out, and I'm just looking at this one, it kind of stood out to me significantly that the overall mix that a target date fund is seeking to achieve may not line up with your overall risk or your overall situation. I mean, worse yet would be someone that is striving towards retiring early. Say you were able to retire at 60. Retiring at 60, the easy approach with a target date fund, you might have said, well, I was 60 when it was 2020, and so I picked the 2020 target date fund. You're holding a fund, you only have 44% in stocks, and this money needs to last you 30 years. That'd be akin to telling a 30-year-old you should only have 44% in stocks because you're going to need to start drawing money at age 60. No, you wouldn't do that. Or a 35-year-old, you wouldn't do that. So working with a certified financial planner to take a more active and hands-on approach to diversification is likely going to make more sense. So what's the solution? We call it the personal pension plan. How much money are you going to be withdrawing, do you expect to withdraw out of your investments over the next 2 to 3 years? That money should be sitting in short-term, hopefully interest-bearing investments. Now, for a couple of years, they haven't been paying any interest, but short-term investments, so that if the stock market sees a sudden decline, you're not in a position where you have to start selling stocks at low prices. You've got cash, you've got a moat around your financial house. That's 2 to 3 years of cash. That's what you're withdrawing from. Your middle bucket, the money, and that is equal to the amount of money you're going to need for, the 7 years, 5 to 7 years after that. Right? So from years 2 to 7 or 3 to 10, somewhere in there, okay? That money should be in medium risk, hopefully interest-bearing, higher interest-bearing investments, and the interest should be paying into bucket number one to help that one last longer. As bucket number one gets depleted, you replenish it with that middle bucket, that medium risk bucket, again, lowering the odds, lowering the chances that you're going to have to sell investments, that medium risk, when things are low. Once you've done that math, the money you don't need for 10 plus years should be invested for your risk tolerance, but for the long term, which is more growth-oriented investments, okay? When you look at that entire mix together, 55% maybe in stocks, depending on your overall situation, okay? So number one, that's the first recommendation that I would have. And then second, you can still accomplish this diversification approach, and I would argue more than just diversifying your strategies as well, but you can get a diversification approach without having to go prefabricated in just one fund. In fact, working with a certified financial planner, you should be able to take a look and say, I like this large cap, this company has the best large cap fund, but this other company has the best mid cap fund. This other company has the best small cap fund. We want to have X percentage in emerging markets, and this company has the best emerging markets fund. And yes, that changes and whatnot, and so you've got to be actively looking at it. You've got to be rebalancing, but you can customize, you can build out the right mix with the right managers playing the right roles, the roles that they're naturally gifted in or they're strong in, to get a more diversified and better diversified investment approach. Work with your CFP on all of that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.